A major economy in crisis. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, this major economy is on the brink of a total economic meltdown. We'll show you who it is and why they're about to experience the worst case scenario. And is the Bureau of Labor Statistics once again cooking the books? We'll make the case of why the U.S. labor market is nowhere near as strong as the government wants you to believe. Now, let's over to Bloomberg, where he picked today's story up with a headline: German factory orders slump and new sign of economic slowdown. And the reason the factory sector is so critical to any economy, particularly in Germany, because this is a manufacturing base of the entire European Union. When you lose your manufacturing base, whether it's due to a slowdown in demand or it's just due to being uncompetitive in the global marketplace, the next thing that goes is the unemployment data. You start to see workers hit the unemployment line, and from an economic position, that is the absolute worst case scenario. This is something that policymakers we've seen decade over decade have no answer to other than slashing rate, because once people are out of work, well, demand comes crashing down. And the problem with Germany, they're about to drag down the entire European Union as their economy heads into a depression. Data released Thursday showed an 11.3% decrease in demand in January from the previous month, and that is a monster of a number, and that was worse than predicted by, well, anybody. The decline was due to a slowdown in major orders, which after a strong showing in December, were back to their normal level, according to the data, and that is an issue, because when we look at the factory sector, there's two critical issues. One is the existing backlog, the other is a new order flow. So if you have workers, you need work for them to do. So if you don't have a lot of new orders, well, maybe you have a bunch of old orders that were just not priority that you can go work on. And if you're running out of old orders, well, hopefully enough new orders show up, you can keep everybody working. Because when those both start to dry up and in big ways, employers get nervous and they have no answer to, well, the next thing you know, pink slips start to go out in a big way. And for a major economy like Germany, seeing mass unemployment is a huge, huge problem. And we can see the relationship between the labor market and the factory sector. Here, looking at the U.S. data, we have manufacturers' new orders of durable goods, that in blue, on a year-over-year rate of change against continued unemployment claims shown in red. And you can see the decelerations and even contractions when the blue line is below that horizontal black line in new orders, leads to not only rising but persistent unemployment claims. And that is dangerous, because we look at now and you see the slowdown in our factory sector here has led to what we can see is a persistently relatively high number of unemployment claims that doesn't seem to be going down at all. And we can now look deeper into the German data here, and where we see, of course, from S&P Global, going back here a couple of days, weak demand conditions led to a sustained decline in backlog of work across the manufacturing sector. So what that means is these employers were putting all of their efforts on backlogs to keep people employed. The rate of depletion was the sharpest in 3 months and quicker than the average recorded over the current 21-month sequence of decline. With firms reporting a lack of pressure on business capacity and pessimism toward outlook, there was a further round of factory job losses in February. Furthermore, employment fell to the greatest extent since August of 2020. Now, we're going to look at the U.S. data here in a bit, but I just wanted to see just how critical things are for Germany here. You look at this major economy, they're on the brink of an all-out crisis. You lose your labor market on the back, of course, a crumbling factory sector, and next thing you know, you are seeing total economic collapse in every way. But maybe there's hope, because the data comes after a strong number of German exports at the beginning of 2024 signaled that the country's industrial weakness may be easing. At least there's some hope. The protracted downturn in Germany's outsized manufacturing sector is weighing on the overall economy, which may be now in a recession, and that would be optimistic, because we know if this continues at all, it's going to be in an outright depression. But one thing that should be completely strong, and that's the direction in your trading account because we've given you so many amazing signals to our subscribers. Many people ask, Steve, what do you get when you sign up for your reports? Well, I'll show you. You not only do you get the reports, but we're now putting out videos each day for both of the reports, going through most of the signals that are generated, showing you how to look at the chart, where to put the stop loss, how to trade it, giving you my own personal insight. Now let's take a look at a recent trade going back to last year. We look at October 9th, 2023, our CTA Timer Pro. Now what makes this unique is we look at the machine positioning, but we do something the machines don't do. We run a historical overlay. So we show you when they are offsides, when the opportunity is there. When there's a deep short, that means deep and big upside opportunity for you. And then we also have a report on technicals. Many people try to trade those things, but they find themselves getting in late and then out early. We have a proprietary indicator that we add to all of those signals that smooths everything out. Those things like the MACD, the RSI, and on the same day, October 9th, what do we see? A flip on our daily momentum count. That gave us the confidence to suggest to buy it open. You would have bought this candlestick to be up 22.29% right now. And to put this in perspective, this week alone, between the two reports, we put out 9 unique signals. Last week, 12 with videos. One subscriber said, Steve, I made so much money on one trade, paid for the whole year's subscription. And I'm getting email after email, people saying, Steve, the videos make all the difference. There's a free month. Maybe you tried it before. Sign up with a different email. Start making money. We'll show you how. Because the downtrend that many experience when they're trading, well, that's going to be over. But the downtrend in Germany's not. As has been observed for 2 years, as this according to an economist at Commerzbank. This suggests that industrial production will continue to fall in the coming months, and thus contribute to the German economy shrinking again in the first quarter. And that's the key thing about data, is a lot of people say, why aren't things just collapsing faster? Why is it moving so slow? Why do we see things bounce around? Because data generally doesn't go in a straight line either direction, particularly the downside, unless of course you see something like an all-out banking crisis or we see a global pandemic. Things tend to go slowly at first and then all at once. And well, for Germany, the manufacturing sector, it continues to slowly slide, and it looks like in a matter of a month or two, we're going to see it outright plummet to the downside with mass unemployment falling. Here we see the German industrial production rises for the first time since April, perhaps giving hope that maybe the factory data was slightly off, but hang tight, because even though the gauge increased by 1% from December, this led by construction, what we see is a bigger than previously reported decline in the prior month. So downward revisions, that's an issue we'll have with the BLS hanging to later in the show. Within manufacturing, chemicals, food, and machine output, those all rose. But car makers saw a steep decline. Of course, we know that Germany is a major exporter of cars, and that tells us demand is slowing down. Because you look back post-pandemic, there was just an undersupply of cars for all the demand. And now what do we see? You go down to a showroom and start to see that dealership lots are piling up as people don't want to buy. Not good when your manufacturing base is keyed around that of automobiles. In fact, the overall level of production remains close to the lowest level since 2020, so maybe this turnaround here wasn't that big at a time when Germany's manufacturing sector was struggling to shake off a protracted downturn. Here we can see that in the increase in the production index at the beginning of the year is long for a break from months of industrial decline. However, gloomy survey data, there you go, bode ill for industrial activity in the coming months and suggest a slowdown will likely resume soon. And that's our case, because here you can see the global head of macro at IMG. Well, he suggests that the economy there is bottoming out and still won't be enough to prevent a first quarter contraction. The issue here is if the rest of the world is slowing down and you're seeing demand for your goods go away, this isn't a bottom. What we should be hearing here is, yes, the data was down, but a lot of new orders are coming in, or yes, we're seeing demand in other places to suggest that new orders are going to come back. You're not hearing that at all. In fact, when you look at the U.S. data here, you can see again the strong link to production in the factory sector, whether it's manufacturing, industrial production data, and the employment market. Here we again have continued claims now against industrial production, showing that on a year-over-year rate of change. But look at this, we have data going back to the 1960s. And here you can see that what you have is decelerations in industrial production and then outright contraction shown when the blue line is below that horizontal black line. What does that lead? Is to an increase in people on unemployment and those who are staying on unemployment, as we note continued claims. And you can see that relationship continuing here, suggesting that as we know right now, the U.S. labor market has a problem. Made the case in yesterday's show of why we're going to see a huge surge in unemployment claims starting as soon as next month. If you missed it, go check that out. But today we have the Nonfarm Payroll report. And as I started the show, the question remains is the Bureau of Labor Statistics cooking the books? Going to make the case why they absolutely are doing that. And here we see U.S. jobless rates hits a 2-year high, even as hiring stays strong. That doesn't make any sense. Non-farm payrolls advanced 275,000 last month, falling, but get this, a combined 167,000 downward revision to the prior 2 months. And that doesn't make any sense because what you're seeing here is the government's putting out big headline numbers, knowing that the market and everyone's going to react to it. And then again, the following month and the month after that, they say, oh, you know what, we're a little wrong about that. Let's downward revise it because nobody seems to notice or care that what it suggests is the U.S. labor market isn't as strong as these headline numbers suggest. Notably, the unemployment rate now ticked up to 3.9%, and average hourly earnings that everyone has been talking about how strong wage growth is up only 0.1%. The payrolls and wage numbers are derived from a survey of businesses and other employers, while the unemployment figures come from a separate, smaller pool of households. The later survey, we'll look at that here in a little bit, suggests a reflected jump in the number of unemployed workers. So what that's notable here is it suggests a trend now that people are taking on multiple jobs as they lose, of course, a primary worker's ability to generate income for the household. And while February is a strong point, we'll head over to Zero Hedge here. It's a placeholder until next month's downward revision because January's blowout 353,000 print was revised sharply lower to just 229,000. Could you imagine a statistical error of 35%? Because that is what the BLS said. They got it so wrong, it revised it down by 35%. Again, what you're seeing here is it gives us this indication the government's trying to just keep everyone believing the economy is good, because if they do, they'll go out and spend. But the reality is, the consumers know it's nowhere near as strong as that headline number suggests. In fact, there was a divergence between the establishment survey and the household survey. Of course, the one we've been looking at is the established one. And when both declined, or when the household survey declined again, this time sliding to 160.968 million, from 161.152 million, down 184,000. So meanwhile, while the BLS is suggesting that the establishment survey shows all these jobs created, households are saying, you know what, we're not seeing that at all. In fact, we're seeing just the opposite. But there was some good news on the wage front. Well, if you're the Fed, average hourly earnings growth dipped to 4.3% year over year from 4.4%. That will help, as we'll see, push downward pressure on inflation, while the monthly increase, as we noted, was 0.1%. But here's the key. The average work week for all employees on private non-farm payrolls edged up by 0.1 hour to 34.3, following a 0.2 hour decline in January. We look at the manufacturing sector, which was little unchanged. The work week for production and non-supervisory employees increased by a big 0.3 hours, followed by a decline of 0.3 last month. And one thing that's notable here, and I didn't pull a chart on this because we have a lot of other things to look at, is when you see a slowdown in hours worked, well, what it suggests is people don't hire. And that's another issue I'm having with the Bureau of Labor Statistics here, is it doesn't make sense. If we continue to see mediocre number of hours worked, why are employers out hiring when they could just give more hours to their existing work base? Something doesn't add up. But at least based on the recent survey here, we talked about the total compensation just plummeting last month. That's shown as average weekly hours multiplied by average hourly earnings of production and non-supervisory employees. That bounced back Of course, it makes sense, but notably the trend here continues to be lower, not going in a straight line, but continuing sign of weakness, notably now led by the fact that average hourly earnings are starting to slow down. Not a good sign. But meanwhile, in the State of the Union address on Thursday, President Joe Biden boasted about the strength of the job market and manufacturing employment during his term. The problem is for him and his administration between now and the election, well, that doesn't actually going to look so good, because if what we see in Germany is true and demand's going away, and we know the demand in China is weak as well, we've seen signs around the world that there's issues, well, that already means that demand here in the U.S. is going away. And with that, well, it means the labor market as well. And we can make the case here. This is a great chart. We look at total compensation. Again, it shows average weekly hours multiplied by average hourly earnings, this of production of non-supervisory employees, overlaid against manufacturers' new orders of durable goods, both on a year-over-year rate of change. And you can see that durable goods here in red is just slightly lagging total compensation. So when you see a deceleration, as we're seeing now in total compensation, what that means is that workers are seeing their paychecks not keep up with inflation. They're shrinking in every sense. The rate of growth is slowing. That doesn't give them a lot of optimism about spending money in the future. That turns out to lead to less demand for durable goods. And of course, we are made the case in yesterday's show already and earlier in today's that means that more people are going to stay on unemployment, and the longer they stay there, their discretionary spend goes down. Of course, that means more layoffs. Then in turn, once you head down this path, it's very hard to reverse it, but don't tell that to the Federal Reserve, who says they're not far from confidence needed to cut rates, just from Powell's two-day testimony in front of Congress. As we see, we're waiting to become more confident that inflation is moving sustainably at 2%. When we do get to that confidence, and we're not far from it, it'll be appropriate to begin to dial back the level of restriction. Of course, the bond market loved hearing that news, because it knows that when the Fed says they're going to cut in the future, well, it means they're going to cut even sooner, because the accuracy of any Federal Reserve prediction, well, is about as bad as anything you can imagine. And the data suggests that very clearly, that we're going to hit that target, because taking the last slide of total compensation and manufacturers' new orders, now overlaying in green, and I made that a little bolder so you could see it clearly, is the consumer price index. And what I want you to see is, first you see where total compensation growth, demand for the economy in terms of durable goods, follows, and then after that, with a decent lag, is inflation here. And what it suggests is indeed the consumer price index is going to come down. We're going to see inflation further decline, particularly with all these people that are stuck on unemployment with no opportunity to get a job. And again, it doesn't make sense. You think about this weekly data where we see, now around 2 million people on continued claims, and yet here you see the Bureau of Labor Statistics saying, look at all these jobs that were created. Well, what about the people that are on unemployment? Why aren't they getting a job? So is it all new entrants to the workforce? Something here, again, doesn't add up, because there's a simple relationship. You could just boost the hours of your existing workforce. Why would you go hire more people? A lot of questions. It tells me at some point we're going to see some either big downward revisions in the establishment survey, or we see some big drops in that headline number. Powell's remarks add some additional color to officials' thinking around the timing of the first rate cut, bolstering the idea that such a move could come in the next few months. And as a response, of course, interest rates fell, bond prices rose, and that is not a good sign, because what that means indeed is financial conditions are tightening. The bond market responding to Powell's claim, suggesting that the economy of the future, looking ahead, growth and inflation expectations are actually getting worse. Well, that's what the labor market here is telling us. It's what the labor market in Germany is telling us. The manufacturing sectors are actually validating that, along with total compensation growth. It doesn't bode well for where we're headed. Germany first, maybe China second. U.S. with a lag. We'll catch up to them. Just wait and see. But with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.